So we're going to start off, obviously, this is the One Big Beautiful Bill Act of 2025. We're going to call it a lot of different things throughout. So if we're referring to different stuff, kind of keep in mind, this is kind of what we're talking about here. Start with some general disclosures, informational, education purposes only. We're trying to dive into the One Big Beautiful Bill Act, or the Act, or I guess people call it the OBB. A lot of different acronyms. Nothing you hear today should be taken as tax, legal, or financial advice. The other disclosure I'll throw out there too, we are accountants, we're not IT professionals. So if something goes wrong with technology, please throw that into your chat as well that you can't see or you're having some issues, and we'll try to help you out as best as possible. But again, we're trying to figure all this out and make sure everyone can understand some of what's going on. Again, policies can change, or interpretations can vary, and all of your situation is unique, so always consult with an advisor. The other disclosure that I will throw out there, a lot of the changes that were made, you're still waiting on Treasury's guidance on implementation, other very specific rules. I'm sure somewhere in the language it's interpreted wrong, so they're trying to do interpretations of the law. A lot of what we're going to go through here today, knowing that it just passed a little over a month ago, is a lot of information based and not necessarily full-blown implementation procedures. So how did we get here? So April of 2025, the House unveiled this bill. It started in late April. The House passed a version in May 22nd of 25. The Senate went through debate on this and changed it back to the House, and then it went very quick. July 1st, the Senate agreed, the House passed the bill July 3rd, the bill was signed on July 4th. In comparison, if you go back, geez, almost 10 years now, the Tax Cuts and Jobs Act, that was initiated in November of 2017 and passed in December 22nd of 2017. So while this seems like a very expedited process to get a bill passed, the TCJA that passed that many years ago went through a similar speedy process, but it occurred much later in the year. So if one thing that you could take out of this right away, thankfully, the bill was passed in a time of year while we still have more year ahead of us to kind of plan for, instead of having 9 days left for the bill that passed several years ago. So we're going to talk about today, there's some individual changes, business changes, there's some payroll stuff, energy credits that are expiring, and then some miscellaneous items, trying to catch all. Again, some of these will impact all taxpayers, some taxpayers, but on all the different scales, we'll be seeing different levels of interaction. Some acronyms we're going to throw out there. If you could print or take a screenshot of this slide, maybe on your phone, if you want to take a quick snapshot of it, you're going to hear a lot of different acronyms that are thrown out there. In our industry, we use a lot of acronyms. So TCJA stands for the Tax Cuts and Jobs Act. We'll talk about the OBB, which we already talked about. It's going to be called the bill, the act. Just know that when we're talking about changes, we're talking about this specific bill. SALT, unlike putting it on your food, SALT stands for state and local tax. That plays a role in what we're talking about. Qualified business income deduction. We'll refer to that as QBI, QBID, or QBD. Not to be confusing, but it is confusing. Qualified production property, another Q acronym, QPP, that'll be thrown out there as well. But those are some of the key acronyms that we'll be talking about. We'll try to stay out of the code sections as much as possible, trying to make it more user-friendly from that end, but there will be some annotations to code sections should you want to go back and read them and kind of figure out the different process and how we got there. So with that, I'm going to throw it over to David. He's going to start chatting us through some of the individual tax changes that occurred with the Act.
Okay, thanks, Matt. I'm David Hill. I'm a tax partner here at Lane Gorby Trubit. And kind of before we get into the nitty gritty, one of the biggest takeaways we had from the new law, as far as the individual perspective, is a lot of the things that were going to change did not. Meaning the 2025, like things like the tax rates are going to carry forward to 26 and forward. So did want to just point that out there, that a lot of things that were going to happen are not going to end up being the case here. So getting into tax rates as the first one, as you can see, the individual brackets are staying the same from 10 all the way through 37%. But for the taxpayers, it's actually sort of a double win here, because they were going to revert to a higher rate, the pre-2017 rates, and also the top bracket kicked in much lower, around $400,000, and now it's going to be what it is now, which is over $700,000. So that's for individuals there. And permanent, the trust brackets are also permanent now at between 10 and 37, which is what they have been. Trust, though, the bracket itself is still very compressed, meaning you hit the top rate, 37%, under $16,000 of income. So if you do have income in a trust, it's still, you need to do any tax planning you can. That hasn't changed. It's still, like I said, trips into that top rate, almost immediately for that. See, and on to capital gains rates, they're still the same. They have been 0, 15, or 20%, depending on all your other income, what bracket trend. And then corporations are, even though we're doing individuals now, are still the flat 21%. So, okay. So the standard deduction, they've made it permanent now. To if you'll remember, the TCJ back in 2017, what it did is it greatly increased the standard deduction amount and got rid of the personal exemptions, but it was temporary, and they've now made that permanent. So personal exemptions are still gone permanently, but the standard deduction amount is going to be higher on a go-forward basis and a permanent for now. So, and the rates for 25 they went up, slightly. You probably see on your screen, the single is 15,750 up to your joint filing status of 31,500. So, but they did, as part of the act, if you were over 65, that you can get an additional $6,000 standard deduction. And this is what this does, is it decreases, though, as your income goes up, 75,000 if you're single, or 150,000 if you're filing joint. However, it's only available for those two filing statuses, and you do have to have a valid Social Security number to get this deduction. Okay. So we're still talking about people who take the standard deduction right now. If you might remember, back in 2021, you could get a charitable deduction even if you didn't have to itemize, or even if you weren't able to itemize. And this is for people who give to charity, but they don't have enough other deductions going on. So if you don't own a house, or you have a paid off house, or a situation basically where the people are not paying a lot of property taxes or mortgage interest, this is a nice benefit they brought back on a permanent basis for 2026 forward, where you can still get the benefit of that charity even though you don't have those other expenses, which this should help a majority of taxpayers, because almost anything you give will be able to count towards this. But it is, I do want to say, though, it's not all good news for charity. There's a little bit of a caveat we'll talk about later. Oh, I guess you got a poll there. Okay. So these are some of the now we're getting into itemized deductions now. Some of these are unfavorable changes to taxpayer. So mortgages are going to remain capped at 750,000. That means the max loan you can have that you can take interest against would be 750,000. It was going to go back to $1 million, which is what it was before. So, but they made it permanent at that 750 level. As well as home equity loans are not deductible. They're not qualified mortgage interest. So you need to be able to have that planned, when you're doing your financial planning, that currently they're not deductible. It's just something to be aware of, that they were historically. Now miscellaneous deductions, these have not been deductible since TCJA, and this is the big ones for these are your investment advisor fees, your moving expenses, and employee business expenses were the big one. There are some different treatment though for not employer, educator. So if teachers, they do get a little bit of a break though. So, okay. Okay, the SALT tax or the state and local. This is something they've been talking about quite a bit in Washington the last few years. So state and local taxes are, state and local taxes are property tax, it's sales tax, it could also be state income tax. Now we don't have state income tax in Texas, but if you own a property or business somewhere else, you could still have this. And they've been limited to $10,000 maximum for the last several years. And so what Congress has done, and this is on a temporary basis, temporary in this circumstance means there is a plan change. So it's this one, and for example, goes till 2030. But if I say permanent, that means there is no plan change in the future. The law would have to change it. So what they're doing now for this SALT cap is they're making that maximum amount now $40,000, but it does start to come down with your income, or phase out rather. So at $500,000, your income starts to your ability to deduct that $40,000 goes down back down to $10,000 once you hit $600,000 in income. We do think this would be a really good planning opportunity for a lot of people. Different things you could do, timing of payments, things like that, depending on what your years are. So this should be a good benefit to a lot of taxpayers out there, depending on what their tax situation is. But I would recommend you contact your advisor with these SALT things to see if there's something you can do to help lower your taxes. Okay.
I did see a question pop up about home equity lines.
Yeah.
There is a little carve out caveat that you can take a home equity, but it has to be a substantial improvement to the property. So if you're doing a true add-on, I think that's a little misleading when they said that's not allowed. It's really, in the past, people were using home equity lines to purchase cars, boats, different, paying off high debt, other high debts, high interest rate debts. They've taken that away. It has to be solely for the home itself, and it has to be a pretty substantial addition to the home for it to qualify for the mortgage interest.
Right. That's a good point, Matt. And also, to harp on or reiterate something that you said earlier, Congress writes the law, and then the IRS has to interpret it, and then they have to kind of see what they did. So there's a lot of steps too for what their intent was, and we're still kind of working through that. And in fact, I'm not sure if I mentioned it yet, but they said the filing season is probably going to be delayed just because to implement these changes on their end till mid-February. So it takes a while for all these things to get all the way through, from writing the bill down to when it hits, kind of rubber hits the road, if you will, when you go to file your tax returns in 26, which this would be for. So what are we on? Okay, charitable deductions. This is one of the unfavorable parts of the new bill. They now have a floor imposed in there. And a way to think about this is it's a little bit similar to how medical expenses have been in the past, where you had to kind of hit a certain hurdle before it would be deductible to you. So in this example, it's a 0.5% of your adjusted gross income. So in the example they have here, if you had $500,000 of AGI, you would have to have charity in excess of $2,500 to get the benefit for that. But it will carry forward, unlike that medical example. And there's also been a permanent extension of the 60% of your AGI limit. And said another way, that's your charitable can't be more than 60% of your adjusted gross income. And that was the rule. It's going to continue forward. So And actually, I don't have a slide on this, but I did want to mention two things real quickly. 529 plans, they have also expanded to where, so K through 12, not higher education, you can now take a distribution up to $20,000. That's not taxable. And they've also broadened what you can use these on, other than just tuition, which it's historically been. So that includes, now it includes books, materials, tutoring, tests, and education related therapy, which, is great. People can use these plans for more. And another, I think, welcome change for the taxpayer is your dependent care exclusion, which is, this is the amount for you have withheld from your paycheck for dependent care expenses, and then it reduces your W-2 wages for, like, say, daycare, things of that nature. It's been $2,500 for single taxpayers and $5,000 for married taxpayers for a long time, and now they've adjusted that to $3,750 and $7,500, which is a nice benefit because obviously childcare hasn't gotten any cheaper in the last several years. So good to see that. Okay, so and now on to the estate and gift changes. Now, when I said at the very beginning, some of the biggest change was by things that are not going to change. This was probably the best example of that. So before, and how, sorry, how estates work is they take a balance sheet for the day you die, your assets less your liabilities, and any amount of that is over the exclusion they give you is taxed at a straight 40% from the government. So it's a very high tax rate. So right before the TCJA was enacted, the exemption amount was roughly $5 million per person. So it would capture quite a bit of people. It was only increased temporarily with the TCJA through 2025. So at the end of this year, it was 13.9 million, but it was going to drop all the way back down to, it was the 5 million plus inflation, which they thought would be 7 million. So maybe said a little more simple, it was going to drop in half. But now they've made permanent that the 15 million is the new rate per person. That'd be 30 million for a married couple for 2026 and forward. So this really helps quite a bit of taxpayers not have to do, scrambling for wealth transfers, things of that nature, trying to get that done before the end of 2025. Because there's obviously a whole lot more people who are affected if it's a, $7 million number versus a 15 million, over double there. And then did want to point out that has actually been changed in the tax code. So the 15 million amount is the new kind of base number that they base off with inflation going forward. So, and that's all I had for the individual part there.
Ryan, I think you're still got you muted.
Sorry about that. Thank you, David. My name is Ryan Cole. I'm a tax partner at the firm, working in the kind of the real estate arena. I'm going to talk today about some of the business tax changes, not necessarily maybe changes is what happened, is maybe we'll say extensions of things. And when I say extensions, it's somebody put in the chat, and David hinted at a little bit briefly, was, what's the difference between permanent and extended, and can these be reversed? So you may know is the term that it's going to take an act of Congress. So kind of what happened here, there was an act of Congress, and some of these things that were to sunset in 2026 were made permanent. So they were essentially written into the code. So a lot of these things where we say they're permanent, that they actually are permanent. And somebody had mentioned, well, what if a new administration comes in? Well, it's going to take an act of Congress to change those. So that's kind of in that arena. That's where we kind of go from permanent to temporary and temporary/extension. So some, as David mentioned, I think the SALT cap is going to be sunset in 2030. So that's a temporary item from that standpoint. So I think the first thing we'll talk about, and Matt talked about acronyms, so I'll throw one out right off the top, is we're talking about qualified business income deduction. Now, you may see that as QBI. QBID. Also, if the people are out there are code heads, you can say 199A. Somebody may refer to that. So as I'm speaking, anybody who's not paying attention, I'll let you know that there is a poll question up now, and you can answer it. And I'll allow you maybe 20 to 30 seconds to answer it, and we can get back to some of the discussion. All right, time's up. When we talk about the QBI, nothing's really changed here. Now there was talk about, hey, should we increase the QBI deduction, and should, along with that same thing, is the corporate tax rate going to go down? This was introduced in 2017 to really kind of, as the corporate tax went to 21%, it was to give the flow-through entities somewhat of a similar deduction for the 20%. As I stated, this deduction was slated to go away starting in tax years 2026 or end at 12/31/25. But the act, or the OBBB, as you may want to call it, makes the deduction permanent, and also throws a little bone to some people who may have the QBI deduction for a 400 minimum deductions. We're waiting a little bit of guidance on that. I think I've seen where if you make or if your income's up to $1,000, you may be available for that minimum $400 deduction. So one of the big things about the bill is the research and development deductions, or some people call it R&D, some people call it R&E. Prior to this law, and some people have been waiting for this for a long time, prior law required taxpayers to amortize the R&D expenses over 5 years. And so with this, the deductions for the domestic, and I say domestic, R&D expenses are reinstated for 2025. Foreign costs continue to be required to be amortized over a 15-year period. So that's beneficial for where we had to take the cost over a 5-year period. Now those items can be deducted in 2025 going forward. Now I say that remaining R&D expenses from previous years where you'd capitalize and were amortizing can be deducted in 2025 or in 2026. So somebody asked, well, how does that impact on amortized R&D costs from prior years? Well, you can accelerate those deductions in 25 or 26, provided. And then the other thing is, if you're a small taxpayer, and the small taxpayer being somebody that's $31 million of revenue or less, they can amend their tax returns and remove the R&D capitalization. And I say amend, you can go backwards. What you can do is, they say you can amend 22, 23, and 24. There may be questions, well, if I've not prepared my 24 return, what do I do? There may be speculation about that. Again, we kind of had an internal discussion. These tax rules are essentially I think effective January 20th of 2025, the date of the inauguration. So that being said, you may for 2024, if return you haven't filed yet, if they're saying you can amend a return, why would you amend a 24 return that hasn't been filed yet? So that is a point of contention. You may want to talk to your CPA about what should I do in 22, 23? Do I amend those? And 24, do I accelerate that into 25? I mean, I'm sorry, do you accelerate that in 24? So software development expenses are now treated as research expenses, research and development expenses. And these changes to research, there are changes to research credits, and the AMT adjustments are also included in this act. Interest expense deduction. So there is a change here. One of the things that kind of sunset. So 163J was introduced in 2017. Again, it was to limit it was a revenue raiser. It was essentially presented to limit the interest expense that somebody can take, or a company or a person can take, be deducted in the current year or at any current given year. Anything that is limited, it can be carried forward on your tax return. The limit basis in prior years it was 30% of EBITDA for several years, and then it was the depreciation and EBITDA. The depreciation and amortization was removed, and now it's restored to its initial limitation. So that gives 30% of what your adjusted taxable income. Adding back that depreciation and amortization allows for a larger deduction. So that is taxpayer friendly. As many of these business changes are, they are, as I mentioned, if I say taxpayer friendly, they are extending things that we thought may sunset or go away. They're being made permanent, and they are taxpayer friendly. So in the sense of this interest expense deduction, and for you code heads out there, that's 163J. It's a great planning opportunity for taxpayers or for tax payers, as the suspended interest deductions may become available in 2025. Another great change that's taxpayer friendly here for taxpayers in the area of depreciation. So 168K, it's bonus depreciation. The TCJA Act in 2017 put bonus depreciation at 100% of cost, but starting in 23, it started dropping by 20% each year. So we'd go to 80% and 60%, 40%. The OBBB is now permanently extended the bonus depreciation to 100%. So that is great time to, if you're looking to buy property and perhaps do a cost segregation, all those items that were great and beneficial and in prior years, or 2017, 2018, they're back, and it makes it really taxpayer friendly for placing a building and service and perhaps having a cost segregation. The 179 depreciation has also been increased. It's doubled from the 1.25 million to 2.5 million, and the phase out is also increased for 6 to 6.5 million. Now you're required to, the bonus depreciation and 179 are two separate items. The 179 is you're required to have income for, and it's somewhat limited to some facets or arenas of taxpayers. So a new item that's introduced in this act, it wasn't available in prior years, was the incentives for qualified production property, or QPP. There's a new 100% deduction for qualified production property. If you do not take the deduction of 100%, then the property is depreciated over 39 years. And that gives me, you may say, well, what is qualified production property? It's essentially non-residential property that is used to produce tangible goods. So that's, in generalities, that's what it is. It must be non-residential, as I mentioned, used in qualified production activities. New property is primarily new property, but some used properties can qualify. And it must be constructed through certain dates. If the property is misused within a 10-year window, there's potential for recapture of depreciation that you may have taken. And I say depreciation, if you're taking 100% deduction, then that's quite possibly potentially the recapture would be 100%. We're kind of waiting a little bit further guidance on this. I do know, and I noted, it's not noted necessarily in the slides, but I believe this is applicable for July 4th, 2025 and later.
So it sounds like, kind of looking through some of this stuff, interest expense is deductible. So go out, build a production property, take 100% bonus depreciation on it, and you get the interest expense deduction.
Right, that's correct. One of the other items that was extended, not so much extended, but a threshold increased, was a 1099 reporting threshold. In prior years, it was limited to $600, or not limited. If you had amounts paid over an amount of $600, and the 1099 was required, that is starting in 2026. The amount is indexed to or increased to $2,000. It will be further indexed in future years for another amount. So for those that are not paying attention, again, perhaps you can look at your screen and answer the question, and we'll assure you some CPE. We'll move on to the next slide. And other business changes that you you will want to be aware of. One nuanced rule is the section 1202, which is qualified small business stock. It's usually, and I won't get into the minutia of this, even though I did attend a CPE yesterday regarding that, and got a little update in that arena. But it is being increased, the amount that you can exclude from a sale of corporate stock if it was held for a certain period of time. It was originated as stock, or you had the origination stock, and it was held for a period of time. You can exclude up to 75 million. So that's a real benefit for items of people who may have qualified small business stock. If you do have that and looking for, if you're looking to sell and you think you may fall in that arena, please, shoot us a note, give us a call, an email. We can help you in that area. There are also changes to disguised sale rules that would be in the arena of partnerships. Won't go into detail about that. Again, I just want to be aware of it. The partnership rules can be really, really complex, and so that's another item that's been added. There's a new floor to charitable contributions. I think that item's 1%, potentially. Not monumental, but again, that's something that to be mindful of. And the modification to deductibility of employee provided meals. Again, we could kind of go into the minutia of that. If you have a specific question related to that, I know the 2017 Act had some items where we were 100% meals, and it depended if they were employer provided. But this is one of those areas where there's been some changes. All entertainment is still non-deductible. So those are some of the other business changes that have happened. So with that, I will turn it back over to Matt Dobay, and he'll kind of talk to you about some payroll changes and some other items.
Perfect. Thanks, Brian. We'll jump into some questions here in a little bit, but we'll kind of go through some newer stuff that kind of popped up. Some of you may have heard, and some of this was touted along the way, that there's no tax on tips. Well, sort of. We put sort of on there because prior to the bill, all taxes were tipped. But the Act creates a temporary deduction for individuals who receive cash tips in occupation where tipping is customary. That's a key rule here. So you can't just throw a tip line onto any invoices if you're not in that customary side of being tipped. So you kind of think, for the most part, restaurants would be eligible for this. And you get to offset up to $25,000 of tipped income. However, there's a little catch-all type of caveat. The deduction phases out for taxpayers once your modified AGI increases over $150,000 if you are single, and then $300,000 for joint. This applies starting for tax years after starting in 2024, so this applies right now, and it goes through 2028. How this is going to be reported, we don't know just yet. We don't know if it's going to be on a W-2 or if it's specific on a 1099 where it's going to show a specific code where you get to deduct it. But the main part on the no tax on tips is that it's a reduction from your AGI if you itemize or don't itemize. So what we call that is an above the line deduction. So it's not playing a role in some of the other tax aspects that you get to take advantage of. Similar to no tax on tips, there was no tax on overtime, sort of. So again, all overtime was taxed, but a temporary change to the law allows taxpayers to deduct up to $12,500 or $25,000 on a joint return through 2028. So to get this, married taxpayers cannot file married filing separate. You do have to file married filing joint to take advantage of this deduction. Again, there is an AGI limitation on this. So 150, 300, same dollar amounts are being established here. The key here, again, this is beginning after 12/31/2024, so it affects this year's taxes. You'll see it on the 2025 filing. The interesting side on this one, if you compare the two, they're tipping upset up to $25,000. We're on this side for overtime. if you're filing a joint return, but only one, from what I've read, that even if only one spouse or one taxpayer gets overtime pay and you file a joint return, you're still going to get the 25,000. So it's a little commingled there. But if you file single, you get 12,500 versus the tax on tips, you still get up to the 25,000. This applies the overtime side to those that, again, customarily get that would be eligible for overtime. So if it's a salary-based employee that doesn't get overtime, it won't apply. Some energy credits that are changing. And by changing, I mean they're being repealed, they're being taken away. First one is your energy efficient commercial buildings deduction. It's commonly referred to as 179 capital D deduction. These are deductions for commercial, for specific components of a commercial piece of property. Three major components are your lighting, your HVAC, and your shell. Most lighting qualifies pretty quick because most lighting is done energy efficiently now with LED. I'm not sure if they even make fluorescent lighting anymore, but most LED become pretty efficient pretty quickly so that you're able to accelerate that deduction. The reason that's important is without this deduction, that property is typically depreciated over 39 years. So the fact that you can accelerate is always a great opportunity there. To take this deduction, you do need a qualified engineer to create a similar report to show the energy savings, but this is going away. It terminates for property with a construction start date after 6/30/2026. A lot of these buildings take a long time to put into service. If this is something you're looking into and been planning for, make sure that construction starts before that date. Energy efficient home improvement credits. These two code sections are specific, even though there's just one off. 25C relates to generic improvements to the property. So if you had put in new windows or if you put in new door, you would qualify for up to a $1,200 tax credit. 25D was much larger. The most common 25D tax credit was solar panels, and still is solar panels. So putting in a $100,000 solar panel project, you would get a tax credit of $30,000, and so you'd be net out of cost $70,000. For those that have looked into it, have probably been pitched from a solar energy company that you're going to get great tax savings. Well, it's scheduled to go away. So it's terminated for property placed in service after 12/31/2025. So if this is a component that you're looking to get placed into service, please work that quickly because it's scheduled to go away. There's also some clean vehicle credits that are scheduled to go away. Those usually related to your battery powered vehicles. New, used, and commercial credits that were available, those are scheduled to terminate after 9/30/2025. So that's happening pretty quickly as well. The other side that's it's going to terminate new energy home credit. Let's close that. Sorry, popped up on my screen too, so I want to close the poll. The new energy efficient credit relates to companies that construct energy efficient homes, and this is going to terminate for homes acquired after 6/30/2026. There was a slight change to the law there. It's not that you create the product, you have to sell the product as well to qualify for this credit. So these are energy type credits that taxpayers got, and so that cost the IRS and it costs the government money to give these credits. So as we talk about different tax savings for clients, that's also, if it's a tax savings, that means less money going into the government and vice versa. So this is one of the ways to help balance part of this, is to get rid of some credits to give tax savings in a different area. There are some foreign items. We're going to gloss over this pretty quickly just because foreign can be very complicated, either inbound or outbound. We do have support here that if you are having an issue, or if you're looking at foreign-based operations, there are some changes that you need to be aware of. They started changing GILTI, which is global intangible low tax income, and foreign derived intangible income calculations. Again, Not going to go in depth into those, just talking about them. I don't work a lot in the foreign world, so please consult with an advisor as you get into the foreign-based items. The one foreign item, if you have foreign based activity, you usually sell the foreign tax credit. Those foreign tax credits are still available, so you'll see those coming through on your 1099s a lot. Those are still around. This is a little bit more of an in-depth type of conversation, but wanted to make everyone aware of those. We also have some miscellaneous changes. So the child tax credit, the TCJA expanded the child tax credit, and the Act permanently increases the credit to $2,200 starting in 2025. Casualty loss deductions under TCJA, they enacted a component that to qualify for a casualty loss, usually from, and you think casualty loss meaning a fire, a storm, or something catastrophic happened to your property that you're trying to claim a significant loss. TCJA limited those to federally declared disaster zones. That was a temporary adjustment under TCJA that is now permanent with the Act. It also extends a little bit, and it will expand to state declared disaster zones. So be cognizant of that when you're kind of looking through, and it's unfortunate that taxpayers cannot take such losses because it is a life-changing event. Usually why you have these casualty losses, maybe you get a little tax deduction, but it has to be in those declared disaster zones. Big ones being under common hurricanes, floods, forest fires, things like that. A new deduction that was introduced is deduction for car loan interest. So it's a $10,000 deduction available. It's limited. It is very limited to your AGI as well as the vehicle weight. So a couple other things. So to be eligible for this, the phase out starts at $100,000 for single taxpayers, $200,000 for married. The debt must be incurred after December 31st, 24 for the purchase of a new vehicle. Vehicle must be a car, minivan, SUV, truck with a weight rating under 14,000 pounds, and the taxpayer must report the VIN on their tax return. This car loan interest, similar to the no tax on tips and no tax on overtime, is not an itemized deduction. It is an adjustment that goes consider above the line. So before itemized deductions come into play, you'd be able to deduct this interest. There's also, for the gamblers out there, there's a new limitation on wagering losses. In the past, any earnings that you made on a 1099 or W2G, could be offset by similar losses. And our research tool that we have, actually this morning came out, the state of Nevada is proposing that the Democrats on the House and Senate over there have introduced legislation to bring that back to 100%. And most on this call can understand why Nevada is not too happy with that. Another change was created, the creation of tax deferred savings accounts. And I put quotation the Trump accounts. And so what this is that was created was, it applies to children 18 years, under 18-year-olds who are eligible to receive non-deductible contributions from relatives, employers, etc. For the maximum amount that can be given in any given year cannot exceed $5,000. And it's not treated as a gift either. So from a planning opportunity, you still have your annual exclusion to take into play if you're gifting to a grandchild or a child. So the program starts for tax years after 12/31/2025, so it's going to kick in 2026. To take the money out, we're still looking at typically this money cannot be taken out until the child reaches age 18. Don't have a lot of guidance on this just yet. Is it going to be, if it's going to be treated similar to a retirement plan where you get taxed on it and have a penalty if you take it out early? But it's something that exists out there and it is available for taxpayers to utilize. The other side that was introduced was children born between 20 through from 1/1/25 through 2028, will get a $1,000 deposit from the government into a similar account. There, that plan, from what I've read, is it will happen automatically unless you elect out of it. Keep in mind too that if the child is born between those dates, you still are eligible for that $5,000 on top of the $1,000. So there's a lot of opportunity for transfer of wealth here that was introduced with these tax deferred savings types of accounts. Again, more guidance to follow on this side. It's just, this is a very new concept. The other side of it is, depending on when you take it out, it could be taxed as ordinary income, could be taxed as capital gain income. So we're going to keep an eye on that and see where that goes. So that will kind of jump into some questions.
It looks like there's a question out there about what major purchases can high net worths or closely held businesses take advantage of under the new 100% deduction. Well, I would caution any high net worth individual to try to take something that's not a business deduction, and that's what these would be. Closely held business, some of the things, as I kind of mentioned, a business looking to buy a building doesn't have to be so much big as a building, but those are arenas where you can save a lot of tax, is where you can buy a building and do a cost segregation where you take a building that would typically be 39 years and take it into components where you could maybe put it 5, 7, or 15 years. Another area, which is big back when bonus depreciation came back, is, and not that the car is around too much anymore, but everybody said, go out and buy that Hummer for you. Go, this big tank that drives around, and just slap a advertising sticker on it and you can take 100% of it. Now, some vehicles are limited in a sense of the 100%. They may call it 100% bonus depreciation, but luxury cars are somewhat limited, and you have to look at your car. The same rules probably still apply, but it's built on a chassis and it's over 6,000 pounds. Some of those would be eligible for bonus depreciation. But big ticket items is something that you would look for in a closely held business for items that would be eligible for bonus depreciation, and they'd have to be used for business use.
One question, I thought about this, wanted to bring it up. Which of the changes are you most excited to present? To me, I'd be the R&D side, just because you have the applicability to go back and change. But it's one of those that it's great going forward because you're just doing what you're doing. You should be able to take those expenditures. But on the flip side, I want to caution taxpayers that working with the IRS is extremely difficult right now. And so to go back and amend and think that, great, I have all this available money out there or taxes that I paid in the past. Now you're telling me I can go back and amend my 22 and 23 return to get that money back. Yes, you are entitled to that money. We just don't know when you're going to get that money. That's the hardest part right now. So as much as we're trying to get taxpayers the most advantageous result, part of it should take into consideration that money may not be readily available as quick as you think it will be. So there's a lot of planning opportunities there to say, maybe it makes sense to carry this into another tax year, take the full deduction in those tax years, because I know I'm going to be saving real money. I'm not getting money back, but I'm not needing to pay money in the future. So it's a big consideration that I think taxpayers need to really kind of look at and understand. It also changes a lot of carryovers, which kind of rolls into another question of unallowed charitable deductions. Those are carried forward 5 years. Ordering rules of those are scheduled to come out. In other words, if you have a suspended carryover that rolls into a subsequent year, you'd think you would use those first in your computation. That's what we're waiting for guidance on, and how they apply because of that 0.5% floor, how that will apply to carryovers.
There's a question out there. Can you deduct interest and property taxes on a vacation property? And one of the things that tax professionals usually use is the word "it depends," and it truly does. We're here to kind of provide. That wouldn't have changed in this bill at all. If you're holding out the property as a, let's call it a investment, you could potentially take that interest in property tax under an investment expense. Your interest would be limited, or your interest expense then would be limited to any interest income you had. And your property tax, while you may want to treat it as investment and try to avoid the SALT cap, it may be scrutinized and also would be subject to be an add back for AMT. So that wouldn't change. That rule wouldn't change with the new rules under the new act. Interesting question. Also, I saw that would a pool be considered qualified improvement under a HELOC interest deduction? Now, I don't have a definite answer there, but I said given the conservative nature of some of these rules, and this wouldn't have changed either. But I think it would have to be a structural improvement to the building, or at least the residence. And I wouldn't think that a pool would qualify. I could be wrong. Sometimes pool, I've seen a court case where somebody constructed a pool for a medical expense and were able to deduct that. So facts and circumstances do matter, and it's finality. Again, the answer "it depends" is always while it may sound like a cop out, it is a valid answer to add for a caveat.
And some other questions in the chat. One item that did pop up, and it's a conversation side. When the bill was first introduced, they talked about eliminating tax on Social Security. Again, that's kind of a sort of what they did to kind of sort of make it tax payer friendly was include that additional $6,000. So you're chipping away more on the applicability of the Social Security because you have a higher standard deduction and you have the elderly side of the extra deduction. Same old's true with the tax, no tax on overtime and no tax on overtime pay. If you think it through, the real no tax due is occurring because you're going to get, let's just say for overtime, $25,000 filing joint plus your standard deduction. So really, you're first from an income tax perspective. I think it was $32,000. So you're looking at $57,000 of tax-free earnings with that deduction. So it's really, on that side, it's kind of aimed towards the, as you get into more of the a little bit higher earners, once you get over $100,000 and stuff like that, you start seeing more of the benefit there. So if your only sold tips were, and your sold wages, say $15,000, you're not really getting the benefit of that because you're going to get the benefit of regardless through the standard deduction. Another side, to apply to receive the $1,000 gift, I believe it's just applied for once when the child is born. Using, and for the first iteration that I read, it's once the parents register the child with Social Security, then it would automatically be put into their account. The deferred income gifts, those aren't deferred income under the new the Trump accounts aren't considered gifts. Those are just a way to set aside money in any given year. You still have the ability to use the 529 plans, and there is the acceleration of 529 plans still 5 years of exemptions. Remember, David?
Yeah, I haven't seen any changes to that.
Okay. So you'd still get the ability to utilize 5 years of gift exemptions in 1 year to fund the 529 plan. It would just be spread over the 5 years.
Matt, I have one question for you. Of these changes, what are you of these changes or extensions or things that are made permanent? What are you most excited about presenting to your client?
So the other one on top of the R&D, I do like the depreciation side and the commingling of 163J, the interest expense limitation. Some of the property that's getting purchased can be pretty sizable. So not only is it the ability to deduct the interest, which was suspended due to some changes, the ability to do that, the ability to get new products in the door is not only going to help the product, the person that made that piece of equipment, but it's also going to help the person acquiring the property to grow their business as well. It should help a little bit on the economic side as well, because it'll help borrowing, especially if you're getting qualified production property in the manufacturing side. There's definitely an advantage there to go out and take a loan against it and utilize your money in other ways. Even though you're still paying interest, there still is a deduction component that is available. So money doesn't cost as much anymore as it has in the past. So if we got, again, we're still kind of keeping up with a lot of these changes. The hardest part to all of this, and everyone's seen it, the cutbacks at the IRS, the cutbacks with Treasury, is the fact that guidance may take longer to come out. And as more guidance comes out, please keep an eye out for emails, any updates, and anything else that's significant. We'd love to dive back into our conversation today and talk about different items that we can help anybody with.
Yes, thank you all for speaking. Thank you everybody in the chat for submitting your questions and for attending today. I just wanted to reiterate that this should be posted on our YouTube by Friday morning. You will receive an email with the recording as well. If you answered yes to our last poll question, we will be reaching out to you to answer any additional questions you have about the bill. If you think of a question, you can reply back to the email you're going to get with the recording, or you can contact us on our website if you can't find that email again. We have a lot of tax partners, these included, that will be able to answer your questions, as well as we have a certified tax coach on our team. There's only about 800 in the US. We have one here at LGT. We also have a blog we send out monthly. We're going to be updating with the One Big Beautiful Bill updates. If you'd like to be on that list, you can email us at the email you saw on the last slide as well. And thank you for attending. We'll be putting out more information in the coming weeks and months, and we're happy to answer all your questions. Thanks for joining.